So welcome to this webcast. As I said, it is a special edition webcast that we're running on ASX Hybrid securities. We thought we'd run this webcast for a few reasons. Primarily though, we think that there is quite a bit of value in the hybrid space at the moment. These are securities that for some time have been seen as relatively unattractive by some parts of the market, and now they're throwing up relatively attractive yields. We expect a lot of new issues to come out soon as well, so there's a bit of activity happening in the space. So just before I do get into the session, you do need to be aware that anything I say is general advice only, and so it doesn't consider your personal financial circumstances. You really have to consider if what I'm saying is appropriate for you. The other thing that's worth mentioning is that past performance is not a reliable indicator of future performance. All right, guys. So for those online who don't know our business, I guess there's two parts to it. There's Emerald Financial and Traders Circle. Traders Circle has been around since 2005, and it's really a business by traders for traders. We provide full service support for short-term trading, provide advice on short-term trading. It's mostly focused around derivatives, and we provide education and training, I should say. Now, we've been doing that for quite some time, and over time, more of our clients have asked us, well, we love the short-term trading, we like the education. What about, longer term investment positions? What about, things we can leave for a long period of time? We don't have to watch so frequently. And so we created Emerald Financial really to create the distinction between, short-term trading and longer-term investing. So Emerald Financial focuses on the sort of more longer term investment side of things. We provide research, we provide investment advice, we provide stock suggestions, portfolio management, and both sides of the business provide execution services. So tonight's presenters, there's myself, Sam Green. I'm an advisor here at Traders Circle Emerald Financial, and I'm also an analyst, analyze investment opportunities. And tonight I'm joined by Michael Cornips. Michael's online as well. He's our managing director here and head of our business. Yeah. Yep. I'm going very well, thanks, Mike. And yeah, God, I look a lot younger in that photo there. So in the next one, we'll make sure. Exactly right. Exactly right. All right, guys. So let's get into it. So we're all here basically to get educated on what a hybrid security is. So essentially, a hybrid security is a generic term used to describe a security that combines features of both debt and equity. Debt and equity each have unique features, and hybrids are any security really that combine one element or more of each of debt and/or equity. So hybrids typically promise a fixed, or so they promise a rate of return that can be fixed or floating, and that's until a certain date. And in that sense, they're very similar to debt securities. You think of a bond, or you think of even sort of, your mortgage. There's a promise to pay back, a fixed or variable rate until a certain date for a certain amount. So hybrids typically have that sort of feature, but they also have equity-like components. For example, they can lead into conversion to equity, for example. Now, another example is they might not rank as highly as debt when it comes to, getting back your money in the event of, a business collapse or something like that. Now, because equity is seen as riskier than debt, hybrids typically pay a higher return than regular debt securities. So in that way, they're seen as somewhere between debt and equity on a risk and reward scale. So I've just stolen this chart from the ASX itself, and basically, it's used to show the risk versus return of different asset classes. Cash obviously has very low risk and a very, very low return. Bonds, slightly higher risk, slightly higher returns. Shares, quite high risk, quite high return, and hybrids somewhere in the middle between bonds and shares. Now, the ASX has used volatility here, which basically is price volatility. the change in prices and how rapidly that occurs as a measure of risk. And really, it's one of the most common and reliable ways of measuring risk in financial mathematics. Other ways of measuring risk aren't that easily quantifiable. And basically, they're saying that a little bit more risky than bonds, a little bit greater return, a little less risky than shares, a little less return. So there are many different types of hybrids. Unfortunately, it's not as simple as, this is the hybrid, this is how it performs. There are slight differences to all of them. Now, the ASX breaks it down into three main categories, but the reality is that each hybrid might have elements of each of the different categories. So the first category is convertible or converting securities. The second category is preference shares, and the third category is capital notes. So convertible or converting securities essentially give either the purchaser of the security or the issuer of the security the option to convert into another type of security. So this is almost always the hybrid converting into a share, basically, or into multiple shares. Almost always. In fact, it pretty much is always on the ASX. Now, this is usually at a specific date in the future. Sometimes there are, other convertible securities, but it's almost always that it converts at a specific date in the future, usually well telegraphed, in advance, usually marked down when they issue the security. Preference shares are the second major category. So they usually carry a specified dividend rate. So that could be a fixed or a floating rate. And preference shares are often redeemed for cash at maturity in the same way a bond is. So they're called preference shares because they rank above ordinary shares for the payment of dividends and for the recovery of capital. And so a good example of this might be during the COVID period when a lot of the banks basically cut the dividends for their ordinary shares. They cut them by 50% in some cases more, some cases they avoided paying dividends. They cut their ordinary share dividends, but they continued to pay the dividends promised to the preference shares. And so that's why they're a preference share. They get preference for the payment of dividends, they get promised a dividend, and they get preference for the recovery of capital. So often these have a fixed period until maturity, maybe around 10 years when they're issued, maybe a bit less, maybe a bit more, and usually they're redeemed for cash at the maturity date. So usually the face value is $100, and on the date in the future, you get paid $100 cash. So the third type is capital notes, and capital notes really is just a broad category, just a label for many different types of securities, basically. Um, the ASX likes to break this down into three smaller categories, and we'll run through those. But like I said before, the reality is that most ASX listed hybrid securities carry elements of all the different securities. They're not just X, they're X plus a bit of Y plus a bit of Z. So it is important to look at each hybrid offering and judge it on all its merits. So capital notes can be broken down into perpetual securities, and this is basically a security with no fixed maturity date. Essentially, they're structured as if they're going to last forever, and then you get either a fixed or floating rate payment, usually quarterly, on that security until perpetuity. In some cases, they have abilities to be bought back by the issuer, and so on and so forth. The next type is subordinated debt securities. Now, these are very, very similar to just regular bonds, basically. They're very, very similar to regular sort of corporate bonds or bank issued bonds. The reason that they're called subordinated debt securities is because they might rank below the regular corporate bond with regards to the regaining collateral or regaining capital if the company goes under. And so in that way, they're seen as having equity-like features because they rank below debt, like equity would rank below debt when it came to the wind up of the business. The third type is knockout debt securities, and these are securities that give the issuer, or in some cases a third party like APRA or regulators, the right to extinguish them under certain conditions. And a lot of these hybrids are issued by banks and financial institutions as a way of providing a capital absorption buffer if something goes south. And these are securities that, in the circumstance that something does go south, means that the bank has a bit of a buffer before they have to start dipping into things like customer deposits and things like that. So knockout debt securities have conditions where they might be extinguished. So like I said, these are the three broad categories of hybrids: convertibles, preference shares, and capital notes. But the reality is that ASX listed hybrids combine elements of each of these different categories. So you might be asking, well, why might a bank issue a hybrid? They can issue debt, they can issue new shares. Why would they issue a hybrid over debt, or why would they issue a hybrid over equity? So the reason that they might issue a hybrid over debt is, basically simply that they can convert them into equity in a crisis in many cases. So in a crisis where the bank starts taking on a bunch of losses and the share price falls and things like that, their debt might have to keep being repaid and keep being repaid, but they might have contingencies in their hybrids that they can convert them to equity, and so therefore avoid repayment of some of the debt-like features of the hybrid, and essentially provide loss-absorbing capital against their losses. So they might issue them over debt, just basically so that if things go south, it provides a bit of a buffer against repayment. Now they might issue them over equity, so they might issue them instead of issuing new shares, because existing shareholders aren't always the biggest fans of new shares being issued. Uh, they don't mind hybrids because hybrids, when they're issued, don't necessarily dilute the existing shareholder base. So if there's 100 CBA shares and CBA issues 10 more shares, the existing shareholders suddenly own 10% less of the business, whereas if they issue 10 hybrids, well, those existing shareholders still own their percentage of the business. The other reason that they might issue hybrids over equity is issuing new equity or issuing new shares can often need additional costs. It can often need additional documentation. There can be quite stringent regulatory approval or ASX approval for issuing new shares, and there's often limits to how many new shares you can issue. So that's the other reason why they might avoid issuing new shares and instead choose to issue a hybrid. The next logical question is, why would an investor buy a hybrid over debt or over equity? So the main reason that they might buy a hybrid over debt is that hybrids typically offer a higher return or yield than debt. The return on ASX listed hybrid might be higher than the debt of a bank, basically. The other reason is that hybrids often pay franking credits as part of their dividends or returns. And in that case, it might be tax beneficial to the investor to get the hybrid because they receive franking credits, and that is, the bank has already paid uh, tax on the profits that are paid out as dividends, whereas bonds do not carry franking credits. So you can only get the franking credits with shares or hybrids. You can't get the franking credits with bonds. So that's why they might choose to buy a hybrid over debt. Now, why might they choose a hybrid over equity? Well, one of the main reasons is that hybrids often have less price volatility than shares. So if you were to buy shares, in CBA, for example, you might buy it at $80, it might fall to $70 or $60, it might rise to $90. And the risk obviously is that you buy them at, not a very advantageous price and that you take on a capital loss. Now, I'm sure we'll probably see a bit later, maybe with some of Mike's charts, but typically hybrids often tend to be a lot more stable in price. They can drop off a bit, they can rise up a bit, but their movements tend to be a lot smaller in price than the stock itself. And in that way, there's less price volatility, and some people would say that's less price risk. The other major reason why you might buy a hybrid over an equity is that hybrid distributions rank higher and are more likely to be paid than share dividends or than equity dividends. Just go back to my example before, is we had a period during COVID where a lot of the banks cut back on their dividends or they stopped paying dividends, but they still paid the hybrid distributions. And as long as they're able to pay the hybrid distributions, they're often required to pay the hybrid distributions like they would, a debt payment, basically. And so that's why, they're seen as sitting somewhere between debt and equity, uh, you know, typically promise of a dividend, but sometimes you can be, converted into equity or have similar risks to equity. So basically, uh, we sort of looked at the different structures of hybrids, and we said that an individual hybrid might have different elements, of different types of hybrid. So basically, I thought I'd give you an example of the structure of, a typical ASX listed bank hybrid. Now, this is a ABC bank. It's not a real bank, but it is based roughly off, what's out there in the market, based, roughly off the typical ASX listed hybrid. So hybrids are listed at a issue price of $100, $100 flat, and if when they're redeemed, basically, you either get $100 or in some cases $100 worth of shares. Now, this hybrid has a floating rate, a floating dividend rate, or a floating distribution rate. And what that means is that rather than being paid, 6% per annum distribution, you're paid at a margin above a benchmark rate. So we'll touch on that in a moment. Um, the payment frequency of this hybrid is quarterly, and that is typical of pretty much all ASX listed hybrids. They tend to pay quarterly dividends, which can be, quite beneficial about, the timing of payments and things for people. Now, the issue margin. This hybrid was issued at 3.5% above a benchmark rate. In this case, 3.5% above the 90-day bank bill swap rate. This is quite typical of most ASX listed bank hybrids, is they're issued at a margin, or they pay a distribution that is a margin above the 90-day bank bill swap rate. At the moment, the 90-day bank bill swap rate is roughly 3.6%. And so in a moment, we'll see basically what yield this capital note is paying. Now, this capital note is paying franking credits as well. So when we calculate the return, we also need to be aware that we're receiving franking credits on this hybrid. So these hybrids, they often trade on the ASX. The major bank hybrids do trade on the ASX. It might have a code like ABC3GF, and you can just type that into your ASX trading platform and buy and sell it like you could, a regular share, basically. Now, we saw that the margin on this one was 3.5% above bank bill swap rate. The bank bill swap rate is 3.6%. So this is saying that the yield to maturity is about 7.1% per annum, and we may or may not receive franking credits on top of that. Now, this one is convertible, and that means that it can be converted to shares. And the first call date for this hybrid is the 20th of September 2028. So it's about 5 years from now into the future, 5.5 years, and it is a convertible security. So you'll note that there's a date there called the first call date, and that is out to September 2028. Now, if you would actually look at the full term sheet for this hybrid, you'll notice that the maturity is probably after the first call date. So the maturity of this instrument is beyond the first call date. So what does that mean? What happens at the first call date? Well, in practice, as bank hybrids have reached the first call date, investors have been offered the choice. And this is pretty much true of all ASX listed hybrids as they've been, as their life cycle has occurred on the Australian market. And the two options are basically to roll the hybrid into a new hybrid series. So basically, you give back your ABC 3PF and you get ABC 4PF. And the second option is investors can just redeem the hybrid for $100 cash, basically, the issue price or what they paid on entry. Now, in recent practice, a lot of people have chosen to roll over into new hybrids. And one of the reasons for that is basically that as hybrids are listed on the market, they often trade above their issue price. They often trade above the $100 face value of the hybrid. All right, guys, I'm going to pass on to Mike, who's basically going to touch base on the current state of the ASX listed hybrid market and basically talk about what's out there and maybe their yields to maturity and things like that.
What we have in front of us is what we're trying to do is show you a practical way of how to trade the ASX listed hybrids. So what you probably can gather from what Sam was saying is that there's a lot of different elements with the hybrids. But they all got different maturity dates. They've all got a different, so a different coupon, and they've all got a different margin. And if you can look at the columns here, it says grossed up coupon margin, and so all got different elements, maturities, coupon, margins, getting confusing, and what happens is the prices on the ASX, because it's live, and we run these live spreadsheets, and you can see, I've just got the bid price coming in and the offer price. So for us, these are running live, and then what we're trying to do is standardize how to look at hybrids, and the two things other than the preference of payments and legal will get the basic thing really is, what does this hybrid yield to maturity, and what's its maturity, and what's the yield. So what we do is we take all the pure mathematical elements of the price, and then if you look over to the left here, and sell and buy, what we've done is, as that price changes throughout the day, that yield changes. So prices go up. As prices go up, the yield goes down, and as the prices up, yield down, prices down, yield up. So there's about 45 issued hybrids out there, and the total value of the issue is about $45 billion. And the daily turnover of the market's probably around about, $30 million per day. So it's quite a healthy market. The participants in the market are a lot of, it's very popular, these hybrids, because on average, these hybrids are yielding, somewhere 2.5% above the bank bill rate, up to about 3.5% above the bank bill rate. And the lower the yield, down to 2.5%, are the bank issues, the more high quality issues, and the ones that are offering 3.5% above the bank bill rate would be the lesser rated issues like Challenger, IAG, AMP. So the first thing we do is that Sam and I, we sit here and we have quite a few clients, and we have institutional clients, and what they're trying to do is position their portfolios either for the long term, where they want see a yield and they plan to keep it for a year or two to maturity, and then also we have the more opportunistic investor. So, for example, the AMP issue the other day, it's about 3 years to maturity, and that was yielding 7.5% return for 3 years, which is quite a good rate. So our job as traders and as advisors to our clients is say, look, this is a cheap security. If you pay this price, it implies a 7.5% yield. And then, and what happened with the AMP was it was trading about $104, and then and you go, well, why would somebody sell something and then make it so cheap? Well, the market's very much about liquidity, and there's a lot of flows, a lot of institutional flows in this market, And when people are trying to get out of the issue, they'll push the price down. And then when there's a lot of demand for an issue, it pushes the yields up, yeah. So it's all supply and demand, short-term supply and demand, and flows. And what we're trying to do is sort of bring it into one picture to see the relative values. So if you just on down that left-hand column, you can see the ANZ's yielding, depending on the buy price, the sell price, it's 6.4 to 6.49. But a lesser issue like the Bank of Queensland, you can see, it's at 0.7 to 7.27. So, a lot of investors, self-managed super funds, do have a preference for the pure top 4 bank issues, and then for that extra, 3/4, 1% higher rate, they can be tempted into the AMPs and the Challenger. How do I change the page here, Sam? Oh, there we go. So what we do is that this chart here, as you can see, on the bottom is from the maturities, 2024 across to 2029. The longest maturity is about to be issued tomorrow, I think, an ANZ issue for 2030. So the maturities of the hybrids in the market are somewhere between the ones maturing at 3 months, 6 months, out to 2030. And then what we do, you can see that on the left-hand column, is that we plot all these various issues in the market, and we plot what yield there is. So visually, look at the chart, and you can see, oh, geez, what looks cheap here? So you can see what looks expensive is the CBA on the left-hand side, CBA PH, CBA PG. And what looks relatively cheap is the Macquarie issue somewhere around 2026. That's closer to about 7%. And as you can see visually, that the longer the maturity, you can see the trend is for a higher rate, which is fairly usual in any fixed interest market. So you can see that towards the right hand, you can see that Macquarie issue is yielding above 7%. Now, admittedly, Macquarie's can be they're a lesser rating, well, perceived as lesser than the major banks, but at times they can just rally down to the same rates of the major banks. So, there's no outstanding issues in this chart except for the Macquaries that look a bit cheap, and then if you again look towards the right, you can see the ANZ 3 PJ, the ANZ PJ. You can see that's looking a little bit expensive. So if you were trading it, you're looking for something expensive to sell and looking for something cheap to buy. And what our short-term traders do is try and pick up 1 or 2%. Because they might trade $100,000-$200,000 worth. They try and buy something cheap, and then if the good thing is that if it doesn't rally and the price go up, well, what's the worst thing? You just hold it because it's returning you 6-7%. So it's not like you buy a share and it goes sideways. You go, oh, my money's not working for me. Well, the great thing about hybrids is that every 3 months you will get that coupon, and it is earning a yield. So what we have in front of us is the chart of the major banks, and if I can go to the next chart, you can get an idea of the non-major banks. So you can see quite clearly the Bank of Queensland, the BOQ and PE at the front end is obviously very cheap, and whereas the Suncorp PG is expensive. So if you been holding Suncorp PGs for the past 1-2 years, and you saw this, well, it would be logical to sell something for 6% and buy something for 7.5%. So what we try and do is just create a picture that this is a liquid dynamic market, and it's all yield to maturity. It takes in all these different factors of maturity, different coupons, different prices. If you're looking at a screen, there is no way the average person can interpret that price of the hybrid into what does it yield. And you can see that in terms of valuations, hybrids are very mathematically more precise than shares. What a normal share does is a matter of conjecture, matter of earnings, matter of sentiment, whereas these hybrids are much more precise on the yields they will offer. Sam talked about the risks. There has not been, because at the end of the day these can convert into equity if there was a major financial downturn. The reason they're issued is that the banks get to count these hybrids as part of their capital, and the APRA, the governing body, insists on banks having a lot more capital. So the banks want to bring in these hybrids as capital rather than equity as capital. So they are very careful to make sure that anything they say that should happen will happen. So, for example, a couple of months ago, Westpac had a maturity, and it was on really favourable terms to Westpac, and Westpac said, we want to roll it over. Now, the banks can't roll it over without the permission of APRA. They have to give permission. So there was some talk, APRA saying, oh yeah, but you're going from cheap debt to expensive debt, that might affect some financial stability of the bank, and of course in case of Westpac that wasn't the case, but APRA gave approval. And so when there is, we talk about this first call date, that has never not happened, but we have to identify the fact that there is a risk. And there's been some talk, if anybody's been following in the newspapers, about in Europe about Credit Suisse. The documentation, it was completely different. So every hybrids in Switzerland had documentation that by what they call bail-in, they were closed down and they weren't worth anything. But that was because of documentation, not because the central bank had any particular reason to just make it an option to cancel those securities. So what I'm trying to say is it's important to say there are risks. Understand there are risks, but in the Australian market, especially with the four major banks, no issue has failed to roll over. So on the basis of knowing the maturity and knowing the yields, we can advise people on what's the best value to buy stock, or what level to sell stock. Sam, I'll pass this back to you see if I can get my machine going.
Beautiful. All right. Well, thank you very much to Mike for his insights there, and yeah, looking at sort of how he prices hybrids, how he looks at overpriced hybrids, how he looks for cheap hybrids, and yeah, how he sort of helps institutional clients and sort of clients with portfolios to manage their exposure. All right, guys. So I will move on from here. just going to basically talk about, our business, what we offer. I do see some questions coming through, so definitely write them down, and I will sort of address them very, very shortly, and we'll go from there. So you may be sort of a client already. I do see a lot of clients online, which is great to see. So hopefully we haven't bored you to death. Hopefully you've been enjoying it. But for those who aren't, why might you consider doing something with us? Well, firstly, it is a very low commitment. You can just open an ASX trading account with us. It's free. We don't charge anything. We have fairly attractive brokerage rates, especially if you trade online. Our brokerage rates online are comparable to, as cheap as you can get out there. We think we have pretty expert advice. So, Mike's obviously been in the fixed interest market for a very long time. Our business has been around since 2005. And for those who are interested, we do offer hybrid portfolio management. And if you are a sophisticated investor, we do have access to most new hybrid issues. And there can be, great benefits to accessing new issues because a lot of people do have to wait till they list on the market to invest in new issues. All right, guys, so I will move it on to questions, and we do have some questions coming through from Justin, so thank you very much for that. Justin, you've got 3 questions. So we'll start with the first one. How do you measure risk? So, Mike, do you want to address that one?
Most of the hybrids are rated, have a rating, and they're generally in the triple B to A category. In terms of the risk, you're looking at the obviously the balance sheets of the bank and the rating of the bank, and the banks, and especially in Australia. And we did a talk last week about the banks in America. The banks, there's 4,000 banks in America, and for the capital adequacy rules to apply, you have to have over 250 billion assets in America, and that meant 4,000 banks didn't comply with the capital adequacy ratios. So but the Australian banks they all comply with the liquidity ratios and the high quality ratios. If you go into any annual report of any of the banks, there is a capital adequacy statement, and it goes through all the details of how much high quality liquid assets they've got, how much liquidity coverage they have. So the Australian banks, especially, are very tightly run, I believe, by APRA. I think they're quite a good organisation, even if it is a government organisation. And then we do subscribe to external analysis and research for hybrids as well. So and we use external research, which would agree with something is a buy in terms of credit. So the elements of a security is interest rates one thing, maturity one thing, but credit is the question. So we try and safeguard ourselves by knowledge of the risk of the bank and external research. But in general, I think we can say that the banks, including the Bank of Queensland, Bendigo Bank, and Macquarie, are fairly well rated institutions.
Thank you very much for that, Mike. Next question is, how can investors lose money?
How investors lose money is if you go and look at the March 2020, and for a benchmark issue, there's an exchange traded fund for hybrids, HBRD, that did in March 2020, as the COVID first hit, or if you go back to 2008, the hybrids did dip. So hybrids are all about credit. So even though the share market can go down for reasons, the hybrid market value can go up. But so the risk in hybrids is the perception of the value. Is a credit market. Is there some question? When the Fed has to put too much liquidity into the system. So the risk is that the hybrid market can have a drawdown. We calculate volatility, past volatility on securities, where your average volatility for the share market would be 17 to 22%. The average volatility of the hybrids is about 4 to 5%. So the downside is most of the time, sideways to up, but then we have those 2020 moments, 2008 moments. I think there was a credit moment in around 2017, 2018. So the risk is there. And I remember, security that was $100, it goes out to $90 to $85. But then at the end of the day, it's still ANZ paying you a 6% dividend. And for the super funds, they'll just hold it. The short-term traders, they're the ones pushing it down to 80, 85. But again, they all recovered. But overall, way less volatile than the market, and there's been no defaults in recent memories.
Absolutely. And I guess final question from Justin here. Are there hedging strategies that you can use to protect against risk or losses?
So again, talking about risk is there's interest rate risk and there is the credit risk. So the hybrids pay based on a floating rate. So about 2 weeks ago, the 2030, look, 5 years from now, 2028, the interest rate was about 4.25%. So now the cash rate is 3.6%, and it gets set every 3 months. But they were saying that the average for the 5-year rate, for 5 years, the average 90-day rate was going to be 4.25. So to hedge that, you could, we can show people how to do that. You could buy a fixed interest futures contract to lock in that 4.25. It's a hedge. So if interest rates went down from 3.6 and the recession came along and interest rates went to 1%, you could have hedged it out with a futures contract. And if anybody's interested, we do run an IB. We do run another platform which you can trade the futures contracts. So you can hedge the interest rate risk. And then as to the credit risk, there's nothing really available in the Australian market for the retail to hedge the credit part of that risk. If you're a very big hedge fund, you could take credit risk insurance, which is what a lot of the GFC was all about, credit risk. So short answer is no. There's nothing really available in the retail market for that credit risk.
I guess an imperfect hedge might be a short on the equity of the underlying business or something like that.
Yeah, well, that's right. So what as the market's going up, the correlation between the shares and the hybrids tends to be inverse. So in a positive market, so the hybrids can perform well. In a downwards market, the correlation moves from flat to negative to a positive correlation. So you're quite right, Sam, is that you can imagine in 2020 the share market went down to what, 4,600, 4,700, and if you'd taken a put on the share market, that would have more than compensated for any loss on that hybrid. So so very good point. Is that on the downside, equity markets correlate. They correlate to hybrids, but not to the same degree. So hybrids might have went down 10, 15%. Shares went down 7,500 to 4,500.
Absolutely. Hopefully that answered your questions there, Justin. If you have any more questions, or if anyone out there has any questions to add, definitely type them in chat. Always happy for some questions, always happy to interact. I'll take this moment as well to say that, yeah, if you do want to have a chat about, our hybrid services, our new hybrid issues, or if you just want to open a trading account with us, type yes in chat and we can reach out and get in touch. And yeah, like I said, always appreciate some participation. So if you have questions, don't be afraid to put them out there into the chat box. So Justin's typed another question. Are you saying that the risk of losses arise from credit issues or where conversion to shares occur, the price of the shares decline?
To this date, as I mentioned, there's been no conversion to shares. So the closest thing we got was AMP, when AMP was, you remember, it used to be $3-4, and on the way to $1. In theory, if something falls 75%, and there is a conversion risk. But again, there was no conversion even in that. AMP would to get to 85 cents or something from $4 as it was going through restructure. So no, we're not talking about that risk. What we're talking about is that credit risk is for a bank or a corporate is defined as the margin a bank or a corporate has to pay above the government bond rate. So if you could get a chart of, there is plenty of spreads out there. You can go to the St. Louis Fed website, put AA securities and BBB securities. So basically the spread between a bank borrowing rate and a government borrowing rate and a corporate. So those spreads can blow out. So the bank's credit spread above government is about 0.7% above government in very rough terms. And in March 2020, that credit spread blew out from 0.7 to 1.5 and 2% momentarily. So that's what we talk about when we generally talk about credit spread. That is a moving target. So governments, Australian government, US governments have credit spreads. They have, if you want to insure yourself against the default of the Australian government, that might cost you 0.5% a year. What insurance company would you take that bet from? But so everything's got a credit price on it in the wholesale markets, and what we're saying here is that if you've bought, so the Challenger Financial just having an issue coming up in the next couple of weeks, or will come on the market to trade. Now that was issued at 3.6% above the floating rate of 3.6, so come on at about 7.2%. So credit is that 3.6 going to 5%. That's credit risk. So if you're getting 7.2%, you've put $100 in, it's giving you a 7.2% return, and then the market turns around and says, I don't want 7.2%, I want 8% on Challenger, which is roughly 10%. The only way you can give an 8% return on the Challenger would be for that price to go down 10% from 100 down to 90. So the inverse relationship, yield up, the price has to go down. So yeah, so that's what I mean by credit risk. Sam?
Yep. So thank you very much to Justin for that question. And yeah, so basically, Justin did add, assuming that you hold the warrant to maturity. So if you buy, in the initial issue and the bank or financial institution's credit risk goes up, people want a greater margin, and that'll push the price of your hybrid down. Similarly, if you buy a hybrid and the credit risk has gone up since the issue, you might be getting a much higher yield than it initially listed at. In
Correct.
Mike's example, an 8+% yield on Challenger.
Yeah, and it's exactly like the government bonds issued in the US for the Silicon Valley Bank. So they had $100 billion of bonds that are now worth $80 billion. They don't want to take a $20 billion loss today, but the Federal Reserve says, I'll lend you $100 billion on $80 billion of bonds. And what that means is nobody has to take a loss. As long as the Silicon Valley Bank, it's not there anymore, but if you hold those bonds to maturity for 10 years, you're going to get your $100 billion back from the issuer, in this case, the US federal government. So if you're prepared to hold to maturity, the short-term fluctuations on the share market is irrelevant if you're prepared to hold to maturity. And there's, I would say, a good chunk of the superannuation funds would just hold to maturity, not even think about it. And then unless somebody was advising them on what was looking cheap or what was looking more expensive, but a lot of people just have the idea of buy to hold. Thanks, Sam.
Thank you. Absolutely. So thanks very much for your questions there, Justin. Also got another question here from John. I'll address this one. Do investors receive franking credits? So a lot, I would say most ASX listed hybrids do carry franking credits. For the big four banks, they tend to be 100% franked. Some of the other institutions don't do quite 100%. I think Macquarie, for example, does 40%, as we saw on Mike's chart. And that's just a reflection of the fact that, the big four banks pay tax on the Australian profit, and Macquarie earns a lot of its profit overseas and only doesn't pay as much tax on that.
I just need to make a point that those franking credits are inclusive. When we quote it's yielding 7.2%, that would be inclusive of franking credits. And the franking credit rule, to get franking credits from a BHP share, the franking credit rule hold it for 45 days. The qualification period for hybrids is 90 days. So a trading strategy is as the hybrid runs to a coupon date, and it tends to go up with the accrued interest coming from the coupon. You could either sell it for a capital gain before the coupon, or you could take the coupon, and your problem is if you have held it for a month, you won't get the franking credit. So there's a lot of different dynamics. Hopefully you can follow what I meant. A lot of different dynamics on how you hold hybrids. So if you're a super fund, you get the hybrid, you get the franking credits. You obviously get the cash rebates from the government while they're still giving to us. And individuals, of course, franking credits can be good tax offsets. Thanks.
Absolutely. Thanks for the question, John. Thanks, Mike. All right, not seeing any more questions. So if you are furiously typing them out, definitely get them in soon. As I mentioned, if you did want to have a chat with us just about opening an account or what we offer in the way of hybrid services or anything else, just type yes in chat and we'll reach out to you. But yeah, otherwise I think we will probably wrap it up here. It's been a relatively long presentation, so again, hopefully you found it interesting. Hopefully you've been able to take something out of it, and hopefully we haven't put you to sleep there.
We tend to do that.
Yeah, absolutely. I mean, some of this stuff, obviously, it's not always the most exciting stuff, but it definitely can be worthwhile knowing, can be worthwhile hearing about, and figuring out. And yeah, so hopefully you have found it interesting.
And look, we have a lot of knowledge on the desk. Any questions we don't know, we can certainly find answers to. And we are trading the overseas markets as well. So, we have plenty of information to tap into.
Beautiful. All right. Well, yeah. Look, I'm not seeing any more questions. I'm seeing, some love in the chat from you guys. So look, that's always lovely to see. It's a pleasure of ours to be able to, deliver this to you guys, and we're glad that you guys enjoyed it in turn. So yeah, look, on behalf of myself, and I'm sure on behalf of Mike, thanks as always for joining us. Hopefully, we'll speak with you guys soon, and I hope you enjoy the rest of your evenings.
And apologies for the glitch.
See you guys. Bye.
Thanks. Yeah.